love the channel and find it useful in becoming a happy retiree. Subscribe today. We'll go to Pam, who joins us from Auburn. Hey, Pam, what's going on?
Hey, how are you doing today?
Good. How can I help?
Well, I am trying to figure out basically my pre-tax strategies going forward. For the last 4 or 5 years, I make about $68,000, but I've been pulling out pre-taxes, income to where I'm only at about 17,000 of it being in a 403. Now I'm going to be looking to retire in the next couple of years, and my husband is getting Social Security of $2,400, as well as he has a small business that's making about $6,000 a year.
Got it.
We've been itemizing up to now, although I know that's going to end because we've got our house paid off, and everything's just kind of dwindling down for that, especially seeing it's going up.
So you used to have a bunch of itemized deductions, and they have slowly trickled away, and now you just kind of use the standard. Okay.
Yeah, going forward, I'm pretty sure we're going to be standardizing from here on in, even if it was only at the current rate.
Okay. So your standard deduction, what you were saying is you were probably itemizing maybe $10,000 a year, 10, 11.
Yes. Yeah. The last year's was $14,000.
All right.
Okay.
And this year probably won't be that way, so you'll be doing the standard. Which brings up a point about Georgia state taxes, which I'll get to in a minute. And by the way, Pam, this is the other, as we keep fielding questions about the new tax reform, and I know that's kind of what your question is here. Mm-hmm. Another note on this is that it is a little confusing, Pam, because we just had a call about is the individual mandate, when does that go away? Right? When you stop being penalized for not having health insurance, and this is what makes it a little bit confusing. That doesn't stop until 2019.
Okay.
Just some clarification. You still have to have health care coverage in 2018 this year in order not to get penalized. That penalty goes away, Pam, in 2019, not 18. Again, that's part of why it makes this a little bit confusing. I would say the vast majority of the tax changes are already here. They started January 1. They're impacting you already. I've already seen some paychecks start to change. A lot of the headlines will say that in February, you'll start to really see your paycheck change as the IRS gets the withholding changed or helps people get their withholdings changed by February. But I've already started to see this show up in paychecks as early as January, or people's first paycheck. So anyway, here you guys are as a group, and your income, you'd say it's around, between you and your husband, is around 130.
Right, but the way it was now, because I was taking out $27,000 in pre-tax out of my income, it would, it ends up that our adjusted gross is closer to like 70, I guess. It's
how much again? So
last year it was it basically I believe last year our adjusted gross with business and itemized and rentals and all of that stuff ended up being about 42,000. Okay, so we have a lot of tax structure things, but my question is that I'm putting in $17,000 into my 403 right now. All right, I'm wondering if I should continue putting that much in, or maybe putting it, make sure I maximize Roth, because I'm thinking that I'm not going to pay any more in taxes now than if I waited.
Right. Where are you from? The Midwest? Originally, Pam, I sense a tiny bit of Midwestern accent with you.
Yes, it's the Midwestern accent that nobody can identify.
Hold on, let me try to guess though. Hold on. So if you are, it's not fully like a Fargo accent, but I'm just
not even close.
No, not even close. No, I'm trying to process of elimination. I'm gonna go to Michigan. You're Michigan?
Yeah, you're close, but it's probably a lot closer to you than you thought. Western New York.
Oh, okay, you're close. Got it. Well, here's what I'm thinking is that you guys, from your income level, are going to save your taxes. Your federal tax bill likely will go down at least, I would say, around $2,000.
Okay.
Maybe a couple thousand from my tax estimator. Again, that's just a ballpark number. So it frees up a little bit more of capital after tax for you. And it doesn't mean, though, that you should slow down it doesn't mean that you should slow down your savings. Of anything, Pam, these are the haymaking years. Like, this is the harvest. Right. When you get into your 50s and you get into your 60s, then this is the time when you're saving the most amount of money. In fact, the rules change when you hit 50 for this very purpose, because a lot of people need to play catch up, and it's actually called the catch up. You go from being able to put now $18,500 a year under 50, you hit 50, now you can put $24,000 in what you're saying in your 403B. So the answer is yes, you want to take that tax savings and increase what you're putting away, because all that does is that it decreases your adjusted gross income, and then you pay even less in tax. So it's this virtuous cycle that helps you put away more and actually pay less in taxes as you get closer and closer to retirement, to help Americans kind of try to catch up a little bit, because so many of us in America, our 30s are spent getting out of debt. In your 40s, you're starting to save money, and then you have a bunch of kids, and then you realize it's so expensive. And then in your 50s, your kids go to college, and then you can barely afford to save anything. And then when you're 55, they finally get out of college. You've got like a 10-year window to really play catch up. And that's why the rules, to some extent, are designed to try to help Americans get extra money in savings. And this is the time to do it. So particularly, one of the themes that I see with the new tax changes, our taxes on the federal side are probably going down a little bit for most Americans. Why not use that extra after-tax income to put into your 403B, in your case, Pam? And I think it's a smart way to really get, as you coast into retirement, which it sounds like it's getting fairly close for you. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.